What is the danger zone? It's one of the number one rules in my trading program, and it's basically anything that could turn into a loss. So the goal is to try to make money and have a free trade. What do I mean by free trade? Well, once you enter a trade, as I show you right here on the screen, it's not a whole lot of money. It's $17, but I'm trading it like it's $500. Small account, and I can help you turn small accounts into much larger accounts. But if you have a big account, it's not going to matter how much money you have if you don't understand fundamentals on rules, because it's going to go down the toilet just like it would with a small account. So the amount you're trading with really has no merit. You're either understand what you're doing and you can make money, or you just lose money, plain and simple, right? A lot of people that I end up talking to, they're like, oh, if I just had more money, it would make it. No, that's not true. You got to be disciplined enough to stick with your rules, especially when things start going sideways on you. Well, here, trading $17 like it's $500 and turning it into a free trade so that if it goes up, sweet, you make more money. If it goes down, well, you don't lose anything. There's no anxiety to it. You can sleep. You can leave the trade open overnight if you want. Okay, depending upon if you're a day trader, you want to close it out. But if you're a swing trader, you might feel like, hey, that's okay. If you entered on the daily, you should probably at least hold that trade for a day or two. If you're scalping and you are on the 5 minute, 3 minute, well, you probably should be going out of that trade in that kind of time frame. Anyway, I digress. The point of this is to just simply show you that, hey, here's an enter price at 37.41. I moved a stop up to 37.50, which is not completely at the break-even price, because that's not break-even. I got to pay the exchange for opening and closing the trade. So in order for it to be literally a free trade, got to make sure that you cover some of those fees. And the real important part of doing this is you want to place it in a position to where if it does get stopped out, you're going to be wrong. Because the thing that hurts the most is when a trade goes sideways, you get stopped out, and then instantly it recovers and go back up. It's a bad feeling. So you want to make sure you place these stops in an area to where it's going to go much lower, because it'll help you feel like, okay, at least I got stopped out for a zero loss and the sucker went down much further, 10, 15%, or even 1 or 2 more percent, where you would have lost way more money. So in overview, you enter a trade for reasons being that I can discuss later on. And once that trade becomes green, you can place that stop by moving it up into an area, not just anywhere, but just into an area where you know you're going to be wrong. If this was helpful, please like and subscribe.